Breakout trades can skyrocket your profits in the blink of an eye, giving some of the fastest returns in the markets. When trading these, you're harnessing the market's raw power, and nailing one of these is like hitting the jackpot. Stick around, this breakout masterclass could redefine your trading game for good, and we're leaving no secrets on the table. Breakouts are when price pierces up past the resistance level and then continues on an upward trajectory. Breakdowns are when price pierces down past the support level and then continues on a downward trajectory, but for simplicity, let's refer to them all as breakouts. They are some of the sharpest moves in the market and as a result are very attractive plays to catch. But many overcomplicate how to play these trades. In essence, they are simple. We just need to arm ourselves with a few do's and don'ts to tackle them like a pro. Assuming you have watched the previous videos in this series, particularly the one on speed, let's think again about our newfound view on price and its energy. Remember when price 1 took breaks as it traveled upwards and then consolidated under resistance? Well, that is exactly what we want to see when trading breakouts. A good sustained period of consolidation where price gathers as much momentum as possible, breaks out successfully and goes on a monster run. This consolidation is the first and most important piece of information you should be analyzing prior to your trade. It's the clue that the market is giving you free of charge with ample time to plan your trade in advance in a calm and rational manner. What you shouldn't do is FOMO long or short a breakout without having given the trade the respect, time and planning it deserves, as many tend to do. This will likely end you up in a sticky situation as these moves can be fast, and in these moments you're reacting with adrenaline in your system and not utilizing your calm, rational mind. Consolidation prior to the break is a cool-off where price musters up the energy to go for a run. We know this in theory, but we can also see this visually if we know where to look. And the best way we can do so is using our old friend, the RSI. You may remember from the divergences video, once we get taps to the 50 level, the div is invalidated. Well, this invalidation is because the RSI has reset itself, or in other words, cooled off. This reset is exactly what we want to see prior to price breaking out, and here we can see that in action. Price stalls at support, consolidates, resets to the 50 level, and then breaks down. So to summarize so far, you ideally want to see these two clues present themselves. First, consolidation, and second, your reset. Bear in mind when looking for these that you may not always get consolidation on the time frame you drew the support or resistance level. It may be a lower time frame period of consolidation. These are still valid, but just make sure you're not going too far down. For instance, 1 minute consolidation on a daily breakout. You'll have to play around with the boundaries here. Just use common sense when doing so. Make sure not to force this notion of consolidation and that it's actually present. Now that we've covered what we want to see on the price action front, let's look at what we don't want to see. Remember price 2 from the speed video? Well, that's a pretty good starting point. Essentially, what we don't want to see is the opposite of price 1, where price stretches up to or down to the level, doesn't take any pauses along the way, and in doing so, drains its energy. When we have price acting in this way, we are more prone to some of the other concepts we've covered, such as sweeps and deviations, otherwise known as fake breaks. As we know, this is where price acts as though it's going to break out, lures in a bunch of breakout traders that aren't familiar with the concepts in this video, and then unwinds back past the level and punishes everyone that hastily tried their hand on the trade. Speed isn't the only thing we need to be aware of though. Price can also move up in a deceiving manner, putting in a divergence at the point of potential breakout. As we know from previous lessons, this is indicative of waning momentum and again, not what we want to see for a sustained break. What we also don't want to see, of course, are any overextensions on the RSI itself. If you struggle with knowing what a fast move looks like by eye, stay away from any trades that are overextended on the RSI, and by that I mean above the 70 level or below the 30 level. As you can see, trading breakouts is quite simple, but requires a good foundation of previous understanding in order to master. It's no wonder so many are roped in on the wrong side of the trade, and this trading style is often under hot debate. It's one of the first tools we learn as traders, when really it should be saved for the end, when you have all the necessary concepts under your belt to tackle it effectively. In this way, to truly master trading breakouts, we should also keep a keen eye on delta. For those that don't know what this is, please see the video above. Assuming you do, however, to successfully trade breakouts, we want to see the absence of relatively high delta. In simple terms, not an outsized amount. What this means is that there aren't many limit orders in the way of your trade, and that market orders, such as the one you're likely taking, will have a clear path to do their job and fuel the breakout. Now that we've gotten our head around what we do and don't want to see, let's talk about execution. This is something that comes down to your risk appetite and whether you want to take a more aggressive or conservative entry. For the aggressive entry, you can monitor price, and once you start to see price consolidating, look for a clean RSI reset to take your entry within this consolidation. This style of entry, of course, comes with more risk, but in doing so, you will tighten up your entry and your R on the trade to what is likely a drastic degree, as you'll be entering prior to the breakout candle, most of which tend to be quite large. For the conservative entry, textbook theory would tell you to wait for the confirmation candle close. This is a candle that breaches the level and closes past it on the time frame you drew the level. For instance, if you drew a 1 hour support level or a 4 hour resistance level, we'd be looking for a 1 hour bearish close or a 4 hour bullish close. Usually, traders are encouraged to take full installments on this close, but to tighten things up a bit, whilst still keeping our risk under wraps, you can experiment with taking half on a lower time frame close and half on the true confirmation candle, but I'd only do this if you have lower time frame consolidation to work with. For instance, if you're playing a breakout using a 4 hour resistance level, and you were acknowledging a nice cluster of 15-minute consolidation occurring underneath this level, you could take half of your entry as the 15-minute candle closed past the level, and the remaining 50% when the 4 hour closed past the level. But you have to be very cautious with your executions, and understanding and utilizing tools such as delta is very important. Price action traders that don't have this tool would simply use closes to enter. But even when they think they might be taking the conservative approach, they may be longing a breakout into high positive delta, which means that there is heavy absorption from limit asks, and in other words, that the stronger hand in the market is suppressing the breakout to the upside. Now that we've covered this critical principle, we need to talk about our old friend, the trend. Breakouts are momentum-based trades, and on this basis, we should have momentum on our side. The stronger the trend, the more likely the breakout is. And this may be one of the most important ingredients for these plays, but one most ignore as it's the wider context that needs taking into consideration. These plays work best in heavily trending markets, whether to the upside or to the downside. And trading with the trend in your favor will always be the sensible move. In these conditions, we can even start using less effective breakout triggers such as diagonal trend lines. Focus on the aphorism, when strength is present, drop your stringency, as this is critical to understand, especially when trading breakouts. For instance, in hyper-trending markets where you truly have momentum on your side, simple diagonal breaks using closes can be a very profitable strategy. This may seem too good to be true, but in reality it isn't. It simply demands a true understanding of the context at hand and the strength of the trend. Now that we've covered this often misunderstood trading strategy, let's move on to our next video, which ties together everything you've learned so far: confluence.